Hello everyone, this is Marie from MarketsFlow. It is the 19th of July and we're midway through Friday as we bring you this weekly performance for the week ending July 19th, 2019. I'm joining in for Adam, however I will be taking the place of moderator, which is usually Tom's job. Tom will be speaking about this week's performance. So, how are you today, Tom?
I'm very well, Marie. It's great to be on the other side of the table, but I'm really excited.
Good to hear that. So let's get started. This is Webcast 12 for MarketsFlow's portfolio performance for week ending July 19th. Our podcast is recorded every Friday and is uploaded immediately on YouTube. Please subscribe to our channel so that you can receive it as soon as it's available. MarketsFlow is an FCA authorized robo-advisor and digital wealth manager. We're also SEC authorized. Your deposits are protected by the FSCS for up to £85,000. Before we start, I would like to run through our disclosure. Your capital is at risk, and any financial performance figures refer to the past, and that past is not a reliable indicator for the future. With that said, let's cover the important subject of how did the portfolios do.
Thank you, Marie. As you're aware, we're still midway through Friday. So as it stands, our high growth portfolio is up 0.55% for the week. On a cumulative basis, that is 3.69% since inception, which is really at the start of June. The year to date on that portfolio is about 11.51%. The growth portfolio as of this week is 0.64%, and we're still partway through Friday. On a cumulative basis, we are 4.05% since inception. That is again from the start of June, and the year to date is 7.64%. In terms of the ISA, that is 0.20% for this week. On a cumulative basis, that's 2.73% since the start of June. Now, we don't have history on ISA, so I'm not going to mention the year to date. So that's how the performance has been.
Oh, thank you. That sounds really good. And how has the market as a whole performed this week?
Well, the S&P has had a negative week. So as of now, it's about 0.70% down for the week as we speak. This, of course, could change by the end of the day. We do not like to compare ourselves directly to the S&P as we're not fully invested, whereas S&P really is fully invested when you factor that in. Currently, we're less than 25% invested. The rest is in options and cash. The advantage we have is to vary our exposure based on the signals and the market conditions.
Right. So what about allocation within the portfolios?
At a general level, we were more invested in options than in equities. So comparing that to last week, we were mostly invested in equities. However, things have changed this week. And you can tell the difference when you compare our performance for this week for the non-ISA to the ISA portfolios. We did see some spike in volatility, but the overall sentiment is still neutral to negative. Our signals were positioning us for more allocations towards options, and we had to manage sufficient performance as a result of that due to the income we received from options. On the dispersion note, in terms of the market, as Adam has been mentioning for the last few weeks, it is continuing as normal and very much a data-driven market where certain securities are leading, whilst majority of the securities are sideways or tending to show downwards movement.
Okay. And can you tell me a bit about how we risk managed our way through the week's market developments?
Sure, Marie. We started the week very light. We opted for options based on signals, so we've been lowly exposed to the market. We've increased our options allocation, which has helped us generate our returns along with some equity exposure. As our clients are aware, risk management is at the top of our list when we make our allocation decisions. This helps us with liquidity and the option to vary exposure depending on the market conditions. So I'd say that we're fairly cautious, but we managed to generate our standard expected weekly returns for the various portfolios despite being a negative week for the markets.
That makes perfect sense. And as for today, how do things look so far?
Well, the market is tending to shift between negative to mildly positive. Our portfolios, most of them are positive, so we still have another few hours to go. Let's see how it tends to close.
And what do we have to look forward to as we move into next week?
Well, as Adam mentioned last week, that the earnings season did kick off this week with the bank earnings. We'll now get into the deeper end of the earnings seasons with the bigger tech names announcing their second quarter results. As they're large cap companies, there is a tendency for heightened volatility, mainly driven by the variance in earnings. Having said that, one cannot discount other macro and international factors which affect the markets. There has been a lot said about rate cuts, both on the European and the US side. So we shall see. We're going light into next week, as usually is the case at the end of the week, with most of our options expiring, having generated income for us. We're holding some positions currently, and that may change by the end of the day. Overall, our focus is to be risk-reward managed based on the MarketsFlow platform signals, and I think we've executed to that objective. Overall, our liquidity is high going into next week.
That's great. Thanks, Tom. It sounds like it has been a positive week despite the negative markets. So that brings us to the end of this podcast. I have enjoyed this, and we will be back with Tom and Adam continuing next week's podcast as usual. In the meantime, thanks for watching or listening to us on YouTube. Please remember to subscribe to our channel. Have a great weekend, and we look forward to our next Friday's podcast. Take care.